Krispy Kreme is one of those brands almost everyone recognizes instantly. The logo, the green roof, the glowing "Hot Now" sign. Just hearing the name can trigger memories for millions of people. These donuts are celebrated worldwide. People line up for them, post pictures of them, and talk about them like they're a special event, not just a snack. But here's the part that doesn't match the image. Behind all that love and nostalgia, the company has been quietly struggling, harder than most people realize. Even after dramatically increasing revenue over the past few years, profits remain thin and at times completely absent. In 2021, Krispy Kreme returned to the stock market with major excitement, opening around $21 per share. Since then, that price has collapsed by more than 80%. Most of that drop came recently, shaking investor confidence and forcing the company to suspend its dividend payments. This creates a serious contradiction. How does a brand that seems universally loved fail to consistently make money? How does a company with global name recognition, premium pricing power, and massive demand still find itself under financial pressure? The answer isn't simple, and that's what makes this story so fascinating. Krispy Kreme didn't fall into trouble because of one bad year or one bad decision. Its struggles are the result of many choices stacking on top of each other over decades. And to understand how one of the world's most iconic donut brands ended up here, we have to work through the key decisions that shaped its rise and quietly built the foundation for its ongoing problems. Long before the donut wars became what they are today, Krispy Kreme already had a massive head start. The company was founded in the early 1930s, a time when most of its future competitors didn't even exist yet. Decades before Dunkin' became a national obsession, before Tim Hortons spread across North America, Krispy Kreme was already building its identity in the southern United States. For generations, the brand became deeply rooted in local culture. These weren't just donut shops, they were community gathering spots. Families stopped in after church. Students showed up late at night. Workers grabbed boxes for the office. In many towns, Krispy Kreme wasn't just a business, it was a tradition. And that early popularity translated into something powerful: loyalty. People didn't just like Krispy Kreme donuts, they trusted the brand. They associated it with freshness, consistency, and that one-of-a-kind moment when the "Hot Now" sign turned on and everything felt just a little special. That kind of emotional connection is something most brands spend billions trying to build. From the outside, it looked like the company was perfectly positioned for long-term domination. They had heritage. They had a devoted customer base. They had a product that people genuinely loved. In theory, this should have been the perfect recipe for nationwide takeover. But here's where the story starts to shift. While Krispy Kreme spent decades strengthening its identity in a limited region, competitors were laying down national foundations. Store by store, market by market, those rivals were quietly locking in convenience, real estate, and daily customer habits across the country. So even though Krispy Kreme had the earlier start, the wider battlefield was being claimed by others. And once that territory is taken, it's incredibly difficult to win back. This early advantage, which should have been the company's greatest weapon, slowly became one of its biggest missed opportunities. For all the things Krispy Kreme did right in its early years, one decision quietly shaped many of the problems that came later. The company waited far too long to expand beyond its home territory. For nearly 60 years, Krispy Kreme stayed mostly concentrated in the southeastern United States. While that helped them strengthen their roots and refine their product, it also meant they were standing still while the rest of the industry was moving fast. During that same time period, competitors like Dunkin' were aggressively planting flags across major cities, highways, and suburban neighborhoods all over the country. This difference in strategy had massive consequences. While Krispy Kreme was building deep loyalty in a handful of regions, Dunkin' was building daily habits nationwide. They became the morning routine for commuters, the quick stop before work, the convenient coffee run. By the time Krispy Kreme seriously began pushing into new markets, many of the best locations were already taken, customer routines were already established, and brand loyalty had already shifted elsewhere. And this created a structural disadvantage that's incredibly hard to fix later. Because in food service, location and convenience often matter just as much as taste. A product can be better, but if it's harder to reach, it usually loses in the long run. There's nothing wrong with choosing to be a strong regional brand. But problems start when a company wants national dominance after allowing competitors to capture the spotlight for decades. At that point, expansion becomes less about opportunity and more about resistance. So while Krispy Kreme technically arrived first, they didn't move first at scale. Their biggest early advantage, time, slowly slipped away. And by the time they finally decided to chase national growth, they weren't entering open markets anymore. They were entering crowded battlefields. And that's when the second mistake took over, one that pushed the company in the opposite direction just as forcefully. Realizing they had waited too long, Krispy Kreme suddenly flipped its entire strategy. Instead of expanding carefully and steadily, the company slammed the accelerator to the floor. In the late 1990s and early 2000s, Krispy Kreme went into full expansion mode. New stores were opening at a breathtaking pace. Cities that had never seen the brand before suddenly had multiple locations. The excitement was real. The lines were long. The media hype was massive. For a moment, it looked like the brand was finally claiming the national spotlight it had missed for decades. But speed came with a deadly cost. Many of these new locations were built far too close to each other. Instead of increasing total demand, they began stealing customers from existing stores. One shop's success quietly became another shop's failure. On paper, the company looked like it was growing fast. In reality, it was spreading its profits thinner and thinner. Worse, the rapid expansion strained everything behind the scenes: supply chains, quality control, management oversight, and franchise support. Stores were opening faster than the company could properly train staff or ensure consistent operations. Some locations thrived, many struggled, and a few collapsed almost immediately. What once felt like unstoppable momentum slowly turned into operational chaos. Investors loved the growth at first. Wall Street rewarded speed, not stability. Stock prices surged. Executives celebrated. But beneath the surface, the foundation was cracking. The business wasn't growing stronger, it was growing fragile. Krispy Kreme had gone from waiting too long to moving far too fast. They had traded patience for pressure. And with every rushed store opening, they were quietly building the conditions for their next major collapse. And that leads directly into the third and most dangerous mistake, one that shattered trust, shook investors, and nearly destroyed the brand. By the early 2000s, Krispy Kreme looked unstoppable from the outside. Stores were everywhere. Lines wrapped around buildings. The stock had skyrocketed. To investors, it looked like a perfect growth story. But behind the scenes, the numbers were hiding a dangerous truth. To keep the illusion of endless growth alive, the company began using aggressive accounting tactics. Instead of letting struggling franchise locations fail naturally, Krispy Kreme quietly stepped in and supported them financially. They lent money to franchisees, then booked that borrowed money as company revenue. On paper, it looked like profit. In reality, it was debt. This created a fake sense of success. Wall Street thought demand was exploding. Investors kept buying. Executives kept opening more stores. And the bubble kept growing, powered not by customers, but by financial smoke and mirrors. Then the truth started leaking out. As analysts dug deeper into the company's finances, the red flags became impossible to ignore. Sales were slowing. Franchisees were drowning in debt. And the revenue numbers didn't match the reality inside the stores. Once confidence cracked, everything collapsed fast. The stock price didn't just fall, it collapsed by more than 90%. Billions in market value vanished. Lawsuits piled up. Investigations were launched. Executives were questioned. And the brand that once symbolized joy and celebration was suddenly associated with scandal and distrust. For customers, it was shocking. For investors, it was devastating. For the company, it was nearly fatal. In just a few years, Krispy Kreme had gone from the sweetest success story on Wall Street to one of its most painful cautionary tales. And after the financial smoke cleared, the company was left in survival mode, forced to rebuild from the wreckage of its own ambition. After the collapse, Krispy Kreme didn't try to chase hype again. There were no flashy announcements, no aggressive expansion plans, no promises of overnight success. This time, the strategy was quiet, slow, and disciplined. The company went back to the basics. Instead of opening hundreds of new stores, they focused on fixing the ones they already had. Operations were simplified, costs were cut, leadership was stabilized, And for the first time in years, growth was no longer the priority, survival was. One of the smartest moves they made was changing how they reached customers. Rather than relying only on traditional standalone donut shops, Krispy Kreme began partnering with grocery stores, gas stations, and retail chains. This gave them national exposure without the massive risk of building and managing thousands of locations. Their donuts became easier to find, cheaper to distribute, and more consistent in quality. At the same time, they leaned back into what made people fall in love with the brand in the first place: freshness, simplicity, and experience. The "Hot Now" sign returned as a symbol of authenticity instead of artificial hype. Marketing shifted from aggressive growth to emotional connection. Instead of promising the future, Krispy Kreme reminded people of the past: warm donuts, shared moments, and small celebrations. Slowly, trust began to return. Sales stabilized. Franchise relationships improved. Customer loyalty started rebuilding, not through noise, but through consistency. The brand stopped trying to be everywhere at once and focused on being meaningful wherever it existed. This wasn't a spectacular comeback. It was a quiet one, but it was real. And step by step, Krispy Kreme was no longer just surviving. It was healing. After decades of ups and downs, Krispy Kreme today is a very different company from the one Vernon Rudolph founded in the 1930s. It's smaller than some of its competitors in sheer store count, but it's leaner, smarter, and more focused on what truly matters: quality, consistency, and brand experience. They've learned the hard way that rapid expansion or flashy partnerships don't guarantee success. Instead, they've concentrated on building a business that can sustain itself without risking everything on trends or overhyped deals. Their strategy now balances store operations, retail partnerships, and online orders. They've embraced modern delivery systems, digital marketing, and even subscription programs to stay relevant in a competitive market. What's fascinating is that Krispy Kreme still maintains the mystique that made it famous. Even after over 90 years, that "Hot Now" sign can draw long lines. It's proof that nostalgia, combined with smart business moves, still has power. The real lesson from Krispy Kreme's story isn't just about donuts. It's about timing, balance, and understanding your core strength. Moving too slowly lets competitors dominate. Moving too fast risks everything. High costs, mismanaged investments, leadership changes, and shifting consumer preferences can all derail even a beloved brand. But focusing on fundamentals, learning from mistakes, and staying true to what made the company special, that's how a brand can survive decades of volatility. In the end, Krispy Kreme's journey is a reminder to any business, big or small. Success isn't guaranteed by popularity or nostalgia alone. It's built by strategy, patience, and knowing what truly drives value for your customers.